What is up, you guys? Pete DiCarlo here, and today we're going to talk about some undervalued stocks. And to be quite honest, there really is not that many. I was live streaming a couple days ago, and a student of mine asked me, what are some long-term companies that you would invest in right now that you feel are undervalued? And off the top of my head, because I don't really have a lot of long-term investments right now, number one, because I really just would rather leverage my money trading stocks. That's what I love to do. And I'm a full-time trader. I also run a school for it. So that's where my heart lies. But I do love long-term fundamental investing, and that's what we talk a lot about on this channel. And I thought off the top of my head, I was like, there's really not a lot of companies that I can off the top of my head say are great fundamental long-term undervalued companies. There are a lot of companies that I feel are mass speculation plays, but it doesn't mean I wouldn't end up taking a position in it. So I am going to make some videos on those. I am going to be putting some deep dive videos coming out in the next couple of weeks on things like, skills and a couple of those other companies a lot of people are asking me about. But there were two companies that really came to mind when I first thought, what would I be investing in right now? And the two are Callaway, which is ELY, and then the second one is Skyworks Solutions. Both of these companies I had a long-term position in a while ago. Callaway I actually owned down at like $11 or $12 a couple of years ago, actually pre-pandemic, but overall, I really, really like this company a lot. One of the biggest things, if you guys don't know what Callaway Golf is, this is not going to be a deep dive video, mind you, on either of those like I normally do, breaking down how they make money and everything, but we're just going to kind of go over the valuation, PE ratios, and why I believe in these companies. But Callaway is a golfing company, and a lot of you might be like, golfing? Like, how is a golf company a great long-term growth fundamental investment? And you're right in the sense that golf is not this like massive, disruptor type of company. And Callaway itself is kind of like the older generation of golf. Like a lot of our grandparents know the brand Callaway. But one of the biggest things that intrigued me about Callaway a couple of years ago was they were a small time holder in a company called Top Golf. So at the time, they actually owned 10% of Top Golf. If you guys have never been to Top Golf, it is actually a lot of fun. I'm not even a golfer. I actually don't like golfing, but Top Golf is fun. It's kind of like Dave and Buster's-ish vibe. The food is kind of like that, but a little bit better, but really fun. They're these massive, gigantic driving ranges that have kind of games in them. So if you guys had ever go to a driving range when you're a kid, it's one of those places where you go and you hit the ball off of the tee and you blast it out into the stratosphere. But this is really cool because they make games out of them. Each ball has a chip in it. So when you can, if you can keep track of your score on your mobile app, you can go with a bunch of friends, and it is relatively inexpensive, but it's a great place to have like a party, a work function. They actually have offices in it. And obviously over the past year, they've definitely taken a hit with the pandemic, but it seems like this is really starting to come back. And this is a company at Topgolf that I really, really liked. And at the time, they had a 10% stake in Topgolf. And I was speculating with me and one of my investor buddies, Oz, who's part of our group. He's one of our advanced traders over at the Capitalist Academy. We were talking like forever ago about what if Callaway ended up buying Topgolf, and it was going to go either one of two ways. Either Callaway was going to buy Topgolf or somebody was going to buy out Callaway from that position. And Callaway actually did end up buying Topgolf. And I was buying Callaway like, right around $14, $13, $9 a share within this range here for like the past couple of years. And I ended up selling during the height of the pandemic because I was trying to liquidate some positions. I was right around even on Callaway. Uber was down at like $11. And I thought to myself, all right, do I want to liquidate Callaway and put it into another company I think has much more growth? What do I want to do? So I ended up doing that. I unfortunately wish I was buying Callaway down at $3. That was massive. But what ended up happening was they ended up buying Topgolf. So Callaway did end up buying Topgolf, and I believe that the actual purchase price was about $2.5 billion worth of stock. So ELY buys Topgolf. I remember reading it earlier. So they did end up buying, and it was for $2.5 billion. And the thing on top of it is that Topgolf prior was actually appraised, I should say, for the value. The word is slipping off the top of my head, but the market cap and what the company was worth was 5 billion. So they basically bought it at half the price of what the company was actually worth at the time. So overall, I really like this company. I like the future of Topgolf. I think that they bought Topgolf for a very, very deep discount, and I think the Callaway has a bright future. Now, I was talking to one of my students about this because they asked me prior to their earnings, and their earnings were on August 9th. And I said, if Callaway could pull back down to $25, that is where I would be looking to get in. I went through the financials of Callaway, and this company is ridiculously underpriced. I think the P ratio was somewhere around like a 9 or an 8, which, yeah, 9.4. It's insane. So for those of you who do not know what a PE ratio is, essentially it is the price of the stock or the price of the valuation to what the earnings are. So like, let's say that we own a pizza shop. The pizza shop does $1 million in sales each year, and I keep $100,000 of it. That is my net margin. It's 10%. So let's say that you want to come and buy my pizza shop. If the PE ratio was 10, so the company is valued at a PE of 10, that means that you would pay 10 times my yearly earnings. So my yearly earnings is 100 grand. You'd pay $1 million for my pizza shop. Now, what you have to realize is that a PE ratio traditionally from like Warren Buffett, Charlie Munger standpoint, 25 PE or below is considered undervalued. 20 PE or below is very, very undervalued. And we're trading with a PE of 9.4 for Callaway, which is ridiculous. To give you, some sort of insight, Tesla's PE ratio is like 350 something, which is crazy, right? Tesla has a PE ratio right now 338. So that means for every $1 that Tesla makes, you're paying $338 for it. So a 9 PE is absolutely amazing. And if the stock pulls back down to 25, it'll really be like an 8.5 PE. So I really like Callaway. I feel like this is a very good long-term investment. I do think you are paying a little bit of a premium here. I feel like the entire market is overvalued at this point, to be quite honest, but if Callaway could pull back down to 25, maybe 22.50, this is actually a company that I would want to put money in long term. And another company is Skyworks Solutions. So for those of you who do not know what Skyworks Solutions are, they are a semiconductor company. I own this stock for a very long time. I was buying it heavy around $70 to $80. I did close it out right after the high of the pandemic when the market completely recovered because I just wanted to liquidate my positions. At the time, there's a lot of uncertainty around everything that was going on, and I decided, I'll walk away. I'll keep some cash liquid, and it really has not recovered that much. Like it's done a lot better. So like obviously since the lows of 2020, this thing is up right now about 157%, and from highs basically right before everything that happened in February 2020, this thing is up about 38%. So really not bad. But what you'll notice is with Skyworks Solutions is it doesn't get as much love and attention as other semiconductors in its space, like an AMD or, along the lines of that. But what Skyworks Solutions really focuses on is the chips in your iPhone, and they work with Apple. I think like 36% of all of Apple's, or all of 36% of all of Skyworks' business comes from Apple products, specifically the iPhone. So there is a lot of worries for some investors that, if Apple were to make their own chips, which they are doing with their laptops, but that is not a Skyworks product, that it could be harmful for Skyworks. But for me, I think that they have so many great products in the pipeline. I think that this company has great management. I don't think that Apple's going to make their own chips anytime soon for their phones. It just really doesn't make sense for them to spend all that money on R&D when they can just use a company like Skyworks Solutions. They pay a 3% dividend, which is very, very good. And if you look at their PE ratio, it's pretty attractive. As far as like the round number, like I said, 25 or below, it is not that good. Right now, the average is about a 20, so still pretty good. But the industry average for PE, or for this industry, so semiconductor PE ratio average, I think is about like 55 or something like that. Because if you look at AMD PE ratios, AMD has a PE ratio of 51. Oh, actually, the industry PE is 18. So it is a little higher than the average PE. But when you look at it compared to a lot of other semiconductor companies, I feel it's a fair value. But to be quite honest, I really would want to see Skyworks Solutions back down at like 150, even 140 overall. And I'm going to, be talking more about some long-term investments that I would be looking at personally. I'm not really investing long-term right now. A lot, I am younger. I'm 32. That I can be a lot more aggressive with my money as far as trading is considered. And that's why I've been talking a lot more about trading on this channel. I still want to talk about long-term investing, but across the board, guys, there's really not a lot of companies that I feel like are even close to being fair value, or even close to being a deal. In order for me to be buying a company, I would need the company to be a deep discount or at least a discount. And I feel like none of them are. Like, for instance, I love Uber. I would need Uber sub 30 to think about taking a position in this company, which just doesn't seem like that's going to happen. I love Apple. I would need Apple like sub 100 to think about taking a position in this company. So I think that overall the market is entirely overpriced at this point, to be quite honest. But I'm going to continue to actually do some deep dive research each and every weekend because I have a lot of free times on the weekends because I don't post videos then. I'm going to try to find some long-term investments that you guys like. Comment down below any long-term investments that you're in or you're thinking about getting into, and I would love to do a deep dive on that company and kind of break it down and help you guys out. So guys, hit the like button, subscribe if you want access to every single trade that I take live as soon as I take it. Live stream with me and my team every morning for the first hour of market open. Get access to our 60-hour course library as well as our private Discord server for 100% for free your first month. You have absolutely nothing to lose and everything to gain. You can use the code DISCIPLINE and you can join by using the link below 100% for free. Guys, thank you for all the support. Hit the like button, subscribe, and I'll see you guys on Monday. Peace.